Okay, welcome. Today we're going to talk about an incident from your childhood. And the problem is that um, it's so long in the past that most of you probably have a dim recollection of it. Now, for a long time, I had considered taking this out of the syllabus and replacing it with a lecture on the ethics of money. But this was a traumatic event that happened in 2008. I added this in 2010. But by now, well, this is 13 years old. This is 13 years in the past. So why keep it? I decided to keep it because I think it's about to happen again. And that will raise a whole different set of problems than it did last time. So, with that in mind, let's begin and look at the great crash of 2008. All right, now, as with most things of this type, it began with some ideas. Okay, we need to understand those ideas. The first idea was the efficient market hypothesis. And what did that say? It said that markets incorporate all information. So, therefore, market pricing will be mostly correct. The second idea was risk management. That is, they believed that there were sophisticated tools which could accurately measure risk. And if risk could be accurately measured, it could be accurately priced. Hence, it could be eliminated by what's called hedging. Well, the next idea was stimulus. The Federal Reserve kept interest rates very low. Now, I don't know what you know about money, but that's how money is created. That was called monetary stimulus. The government cut taxes and kept spending very high, running big deficits. That's called fiscal stimulus. Now, why did they do that? Keep that question in your mind because we're going to come back to it at the end. Also, there was the idea of lax regulation. Alan Greenspan, who was the chairman of the Federal Reserve Bank, brought in the banks and informed them that they would loosen enforcement. In fact, they wouldn't be enforcing mortgage regulations at all. This was combined with the repeal of the Glass-Steagall Act. Now, the Glass-Steagall Act, what was that? Well, it required that commercial and investment banks be separated. This was a response to the Great Depression, where pretty much the same thing happened as happened in 2008. Now, commercial banking is very low profit, but it's safe. Investment banking has very high profits, but it's risky. With the repeal of Glass-Steagall, the commercial banks became servants of their investment divisions. They provided them with products to sell in a way we'll see shortly. And then there was this idea of securitization. Banks moved from making loans to hold them to making loans to sell them immediately. So they made money as loan brokers rather than as lenders. This changed the relationship between the banker and the borrower. Okay, so all of this was rooted in the firm belief that the free market could be trusted without regulation to efficiently allocate all the new funds that were pouring into the market. All right. That's the theoretical basis. let's look at what was happening. And it starts with financial engineering. And the quants, that is, the quantitative analysts. And the idea was that with proper quantitative analysis, any amount of risk could be priced. And if it could be priced, it could be hedged. So you had the growth of the hedge funds. And here were the principles. The market price is generally correct. Hence, asset classes are correct relative to each other. And so you could find small departures and arbitrage them. And there was the belief that the market is always liquid. That is, every seller finds a buyer. And there would be unlimited borrowing at low interest rates. Now, arbitrage looks for price differences between two markets and uses the lower to buy the higher. Hedging, that's a matter of buying positions in markets that are likely to move in opposite directions. So losses in one will be offset by gains in the other. However, hedging and arbitrage are not that profitable by themselves. The real money is in leverage. Leverage is the use of a small down payment to buy a very large asset. So when you put 5% down to buy a house, okay, that's leverage. Well, here's the opportunity that arose. Interest rates were low for large borrowers and high for small borrowers. If there was a way to buy large groups of small loans, there was an unlimited amount of profit to be made. The answer was securitization, the process of combining many small loans into a large bond. Okay, here's how it worked. These were called mortgage-backed securities, or they could be called asset-backed securities, or commercial mortgage-backed securities, etc. Excuse me. So you take a pool of 5,000 to 7,000 mortgages and combine them into one security. Now you divide the income from this security into tranches. So here's how it works. So think of those, stacks of champagne glasses, with interest and principal payments flowing into them. So it flows into the top tier first. That's tranche A. And only when that tier gets filled up will it begin to flow into the second tier. That's tranche B. And only when that fills up will it flow into the bottom tier, or tranche 3C. So now the higher tranche paid lower interest but had greater security because all the money was going to come to that tranche first. Lower tranches had greater risk but they paid higher interest rates, so you could arbitrage your risk. So it works something like this. There would be a senior tranche, and it would have a AAA rating, and it would be about 75 to 80% of the whole issue. Then there was what was called the mezzanine tranche. It would be rated BBB, the lowest investment grade, and it would be about 15 to 20% of the issue. And then there was the equity tranche. It was unrated. Okay, it was not investment grade at all. And it was about 5% of the whole package. Now it was called the equity tranche because that's the only money that was actually in this. That was the down payment to buy the whole MBS. Okay, so look what happened. Mortgage loans are usually low low rated loans. But by combining them, they created AAA securities from low rated mortgage loans. All right, why would the banks do this? Well, the banks could sell their loans to a conduit, which was theoretically not part of the bank, but which they owned. Now, this conduit would buy these loans not with the bank's money, but with short-term loans raised on the money market. The cash the banks received could be used as hot money to create more loans. Now, you have to understand fractional reserve banking to understand that, but basically, banks do not lend out deposits. They keep deposits as reserves and lend out a multiple of their deposits. So if you deposit $10 and the reserve requirement is 10%, well, they can lend out $100 based on that $10 deposit. Yeah, I know, it sounds crazy, but that's the way it works. Now, the conduit, and you might hear the term structured investment vehicles, packaged the loans into these mortgage-backed securities and sold them off. Now, this allowed the banks to move loans off their books and convert the cash into what was called the shadow banking system. And the shadow banking system was totally unregulated. The banks would then buy back the senior tranche to be used as high-grade reserves, because the higher your reserves are rated, the more money you can lend based on them. So, low-grade mortgage loans are converted into high-grade securities. AAA securities are normally very, very rare. Only U.S. Treasuries and a few large companies can issue them. All right, review. So, there was a solid belief in the ability of markets to function with little or no regulation. A belief in quantitative analysis to properly price risk. There was a belief in arbitrage, a belief in the perpetual liquidity of markets. There was a belief in the perpetual availability of low interest funds. Now, have you noticed how many times I've used the word belief? You would find more faith in this system than you probably will at Mass on Sunday, because this all required a whole lot of sola fide, faith alone. And of course, there was stimulus. The Fed kept interest rates low, the government kept taxes low and spending high. And there was a belief you could convert low-grade loans to high-grade securities. And of course, the repeal of the Glass-Steagall Act and lax regulation. This is just the beginning. The party's just getting started. More engineering. CDOs, CDO squared, CDO cubed. The MBSs had a problem. The investors and the banks liked the senior tranche. The hedge funds liked the equity tranche. Nobody wanted the mezzanine. Okay, no problem. Convert them into a new security, the CDO. And by the way, as we go through this, don't worry about the terms. Okay, they're just clever names for sophisticated betting slips, so don't worry about it. The CDO is a collateralized debt obligation. Here's how it worked. All right, there's your MBS and your CDO. So the money's flowing into the MBS, right? From the top, as we saw, the money flows into the senior tranche, then goes into the mezzanine tranche. But nobody wants to buy this. That's all right. Flow it into the senior tranche of a CDO. You see what just happened? Well, then do it again. Here's your CDO and CDO squared. And repeat it again. CDO to CDO cubed. Do you like this? Is this fun? Let's review this. So you start with the MBS, senior mezzanine equity. You take the mezzanine and you flow it into CDO. You take its mezzanine and you flow that into a CDO squared, and you take its mezzanine and you flow that into a CDO cubed. So think about this. Starting with an asset loan, I mean the only real loan in the whole process, you create a AAA tranche mortgage-backed security. From the lower rated tranche, you create a AAA CDO, and from its lower tranche, you create a AAA CDO squared, and from its lower tranche, you could create a AAA CDO cubed. This, of course, is nonsense, but it still wasn't enough. Credit default swaps. Oh, this is interesting. And synthetic CDOs, because the CDO cubed wasn't synthetic enough. All right, a credit default swap, basically it's an insurance policy written on a security, a stock, a bond, etc. It doesn't matter. So if the bond defaults, the CDS pays off. Or if the interest drops below a certain rate, the CDS pays off, or whatever the terms were. So it was used as a method of raising the rating of securities. So when I was at the City of Irving, we always bought CDSs on our bonds, and that raised their rating to a AAA, and then we could advertise as good politicians that we were a AAA city, which we most definitely were not. All right, but it's an insurance policy, but there are some important differences with normal insurance. First place, there was no regulation. That's just two guys writing a contract. And hence, there were no reserves required. You know, when you buy an insurance policy, the insurance company maintains a reserve against losses. Not here. And anybody could write these policies. Your uncle, your grandmother, anybody could write these policies. But the big problem was that no insurable interest was required to buy them. Anybody could buy them. What is insurable interest? Well, suppose you have a neighbor, and you know this neighbor likes to drink a lot, and he smokes big cigars in bed. So you know sooner or later he's going to burn down his house. So you buy a fire insurance policy on his house, and you send him a box of cigars and a case of Jack Daniels. He'll wait to collect. Well, in fact, you can't do that. Why? Because you have no insurable interest in his house. You cannot buy an insurance policy on it. Right? But you could have naked CDSs. That is, you could buy an insurance policy on a bond in which you had no interest whatsoever. And this is just like buying a fire policy on your neighbor's house. Now, with normal insurance, one fire, one claim. But with naked CDSs, one default could lead to thousands of claims, because anybody could buy the policy. All right. Well, and from the CDSs, you could create a synthetic CDO. So you sell a CDS on some CDO or MBS. You arrange the premiums revenues in tranches. Okay, we've seen this movie before, right? Oh, and you use some of the revenues to buy a CDS on your CDO. This is kind of like reinsurance. Oh, wrong direction. Okay. Or you could use the CDS as a short tool. Buy the lower tranche of a CDO, use the revenue to buy a CDS on the higher tranche. Kind of a self-funding short tool. On collapse, collect a big payoff. Now, the notional value of the CDSs sold at that time were $60 trillion. How big is 60 trillion? Well, at that time, the value of world GDP was 50 trillion. Look what's going on here. Look how crazy this all is. Think of an inverted pyramid here. And at the bottom, this whole thing is balanced on that tip, and that tip is a home. It's the only real asset in the whole system. So the home has a mortgage. That is a loan. Now that mortgage is sold to a conduit who buys it with a loan. And they package it into an MBS, which investors buy with loans, with 3% loans. And they package that into the mezzanines into CDOs, which are bought with a loan. And you have the CDO squared, and the CDO cubed, and the CDS, and the synthetic CDO, and the short CDS. All of it is based on this one guy at the bottom. This guy right here trying to make his mortgage payment. He's the only cash in the system. Wait, it gets real interesting. Things start to get a little bit crazy. All right, we talked about leverage. Okay, means buying large assets with a small down payment. Hedge funds were leveraged anywhere from 30 to 1, that is, they bought with 3% down, up to 80 to 1, that is, they bought with 1.25% down. All right, so you use 3% down to buy securities, which were bundles of loans, which were bought with 3% down, which were bundles of loan bought with 3% down, etc., etc. Now, in the business, this was called gearing, and you can see why. Okay. So there's lots of money in the form of loans and credit and whatnot in the system, but there's not really that much capital. There's not a lot of cash. So there was huge profits, but a small drop in values wipes out the capital. And frankly, it was based on faulty math. The quants had assured everybody that risk was properly priced. Now, this theory, the Black-Scholes theory, had won the Nobel Prize in economics. And it had been tested in a hedge fund called long-term capital management. Well, long-term capital management went bankrupt in 1998. This leads to the question of moral hazard. Why? Because Alan Greenspan decided to bail out long-term capital management, to use the Federal Reserve, even though there was private companies such as Berkshire Hathaway who were willing to undertake a private bailout. Well, moral hazard happens when you don't have to take the consequences of your own actions. Greenspan created this moral hazard by bailing out long-term capital management, and he sent a clear signal to the markets. The banks realized that their failure could bring down the whole financial system. The government would have no choice but to bail them out. The bailout of long-term capital management had signaled markets that there would be no penalty for failure. So, with the implicit backing of the Federal Reserve, big firms could take enormous risks. And tranching had by magic, financial magic, turned risky investments into AAA securities. More loans, give us more loans. Now, I happened to be in the real estate business at this time, and I saw this up close and personal, and it was insane. The financial markets wanted more loans. But by that time, by about 2005, 2006, everybody who qualified for a loan already had a house. So, the hedge funds demanded more creative financing from the mortgage companies and the banks. And the quality didn't matter, right? Since tranching would magically convert them all into AAA securities. So, the banks and mortgage companies obliged with subprime loans. They didn't care about quality, since they were going to sell the loan, not hold them. Wasn't their problem. All right, so you got things, and here's one of my favorite. The ninja loan. What is a ninja loan? No income, no job or assets. You don't like that one? How about this one? Liar loans. What's a liar loan? It's called stated income. They ask you what your income is, and whatever you say, they write it down. They're not going to check it. So, you want to say your income is $500,000 a year? That's what they write down. They don't check it. The liar loan. Or the interest-only loan. So instead of qualifying on the whole payment, you just pay interest each month. And then you can qualify for a much bigger house. And more. I mean, it got really ridiculous. And the complexity. Nobody really understood these. This is a simplified, and I want to emphasize that, simplified diagram of one particular very famous CDO. Okay, sold by Goldman Sachs and put together by this man, marketed by this man, Fabrizio Torre. Okay, and so he created this CDO, a collection of CDOs, Abacus 2007. Okay, Deutsche Industriebank purchased the reference CDOs, and they created the SIV to house the Abacus CDO. Paulson and Company is the one that actually picked out the equities, the mortgages in there. Paulson deliberately looked at the underwriting records to see where there were obvious mistakes. He found the weakest 5,000 loans he could. In other words, he deliberately set this up to fail because he was buying CDSs on it. Now tell me how that is not criminal. Goldman Sachs itself was buying CDSs on the security it was selling. So it was telling investors this is great, but it itself was betting against its own product. All right, I won't go through all of these. The point here is that there were so many players, so many moving parts. Nobody really understood what was going on. All right. Things fall apart. Alas, things often do. Now, the problem was that this had global reach. Securities were sold to banks and investors around the world, and they became embedded in bank reserves. So a US failure would equate to a world financial collapse. And here's the housing bubble. This is the Case-Shiller index. So here's the average level. The average is 100 here. But here's the average. So since the Second World War, right up until the late 90s. You see, it stays at this 110 level, and then it shoots up, doubling in such a short period of time. Of course, then it collapses. And you can see why. Here's US subprime lending from 2004 to 2000, from 1997 to 2007. Look at how it suddenly shoots up in 2004, 5, and 6. Of course, it collapses in 7. This is percent of mortgage originations. So 20% or more of all mortgages were subprime mortgages. And this is the securitization market. This is billions, so this is 2 trillion here. So look how the securitization market grew. CDOs, asset-backed securities, commercial mortgage-backed securities, residential mortgage-backed securities. But by late 2006, borrowers were having difficulty repaying their loans. The CDOs began to fail. That wouldn't have been a problem, but the contagion was spread by CDSs. Remember, you had these fire insurance policies, but instead of one fire, one claim, you had one fire, thousands of claims. This means that money had to be raised to pay off the CDSs because they weren't keeping reserves. So they had to sell assets. All right, here's a timeline of the recession. This is interesting to go through. So July 19th, 2007, Dow Jones hits its high point. It's 14,000 for the first time in history. By August, there's a credit crunch. I'll let you go through this. It's an interesting story. That'll give you sort of an overview of what's happening. But let's look at this question. Why? Why? I mean, after all, why was the housing bubble encouraged by the Fed? Why did the government and the Fed not act sooner? Why did financial markets, people who are supposed to be very, very sophisticated about these things, not recognize the obvious dangers of things like CDSs and CDOs cubed and things like that? Well, here's the truth. There was a silent crisis going on at the time. Even during the expansion, so supposedly we had an expansion between 2001 and 2007, most sectors of the economy were actually shrinking. So from January 2001 to December of 2007, air transport lost over 100,000 jobs. The apparel industry lost 300,000 jobs. The chemical industry lost 119,000 jobs. But manufacturing lost 3.4 million jobs. So by boosting the housing market, they felt they could create the appearance of a boom. And if people felt they were in boom times, they'd keep spending and may perhaps actually create a boom. But it was impossible And it was impossible for this reason: the declining worker share of income. Remember that inverted pyramid with Joe Sixpack at the bottom trying to make his mortgage payment? That's where the whole thing begins. But his share of the national income was shrinking. Here's labor's share of the output. Okay? You see how it had collapsed starting in 2000. Labor was getting less and less of the output. But here's the truth. And it's one that's always forgotten, but it's so obvious. Each firm's wage bill is every other firm's demand curve. Debt repayment depends on strong worker incomes. But the opposite was happening. The FIRE economy had replaced the real economy. The FIRE economy? What's that? FIRE is finance, insurance, and real estate. Okay? So look at this. Just after the war, the FIRE economy was less than 11% of the economy, while manufacturing was rising to about 27-28% of the economy. And from there, it would fall steadily. So the FIRE economy and the manufacturing economy changed places. So we became a people, no longer a people who made things, but people who sold each other insurance policies. Families relied more and more on debt. So here's the debt burden on families. So we had this stable period from the 60s to the 80s. Then in the 80s, we began to get this sort of free market view of the economy. Wages declined, and people borrowed more and more to keep up their standard of living. In these circumstances, it made sense to keep the bubble going and then hope for the best. Now, the bailouts. I just want to point one thing out here. The bailout bailed out the banks, but only the banks. The banks, toxic wastes. That's what all of these failed MBSs and CDOs were called. The Federal Reserve bought them from the banks. Look at this. This is what the securities held outright by the Federal Reserve Bank in billions, in thousands. Okay, normally what the Federal Reserve holds is just US Treasury certificates. But here, in order to bail out the banks, they bought up all those failed MBSs. So the liability was simply transferred to the government. And these are federal agency debt securities, the Fannie Mae and Fannie Mac securities. All right. The bubble was an attempt to avoid dealing with the underlying problems of the economy. We can no longer avoid these problems. After the fall. Okay, the bailouts. Well, there was $700 billion from the Treasury. That was the TARP funds. But there was $1.8 trillion from the Federal Reserve Bank. That was called quantitative easing. That's where they bought up all of that toxic waste. The banks and the hedge funds were made whole, but 4 million homes were foreclosed. And in fact, the people who caused the problem had their funds restored. They could now buy up all that real estate that was foreclosed and buy it up at a fraction of its previous price. 8 million people lost their jobs. So this has been called socialism for the rich and capitalism for the rest. Did it work? Well, disaster was averted. This could have been much, much worse. This really could have been 1929 all over again. And the economy has grown steadily since then. And unemployment shrank before the pandemic to its lowest level. So the economy appeared to be strong. Or is that itself an appearance? Look at this. There's a declining middle class, declining wages, and declining labor shares of income. Look at this. Labor share of income. This is similar to that chart I showed that a little while ago, another version of it. The labor percent of the output fallen from a high of about 64, 65 to down to 56. Now that's a huge loss in income. Look at this, is the real average hourly earnings of production and non-supervisory employees. So these are the line workers. This is adjusted to today's dollars. So back in the 60s and early 70s, workers were getting $26 an hour. That continued to fall under the inflation of the 70s, but then it continued to fall again and again under Ford, Carter, Reagan, and only began to pick up in the middle of the Clinton years. Stabilized under Bush, stabilized again and started to rise under Obama and Trump, and only now has it gotten back to where it was in 1973. Okay, well, that labor share is the foundation of supply and demand curves. So, labor has lost its bargaining power, and without bargaining power, you can't set fair wages. Automation has done a number on labor, and outsourcing has done the rest. So much labor now is contract labor or the gig economy. There's few benefits, almost no rights, and no job security. And there's rising debt. So here's consumer debt. Okay? By the fourth quarter of 2019, it's up to $4.2 trillion. There's student debt. Look at this chart. Okay? So here's auto loans. These are credit card loans. These are, the top here is others. But look how much student debt has grown. Now, student debt, which by the way carries a higher interest rate, generally impedes young people like yourself from starting families, opening businesses, etc. But the really big problem, I think, is corporate debt. It's just going through the roof. Okay? All right, and there's this growing wealth and income gap. Here's the growing income gap. All right? This is the top 1%. You see how their income has been growing since 1999? Well, here's the rest of the top 10%. They've had some growth, some significant growth. Here's the 10 to the 50%, that next 40%. Barely any growth at all, while the bottom 50% has been flatlined. But there's the growing wealth gap. Here's the wealth. This is out of date, but it's even worse now. Um, this is what the top 10% owns. This red is what the next 40% owns. This, that's what the rest of the country owns. These shares, this share is growing, this share is shrinking. So we've become a two-tiered society. This leads to political unrest. I don't care whether you're left, right, center, whatever it might be. The truth is, when you have these kind of economic divisions, you get class divisions, you get political divisions. You get political extremism because people are quite rightly very angry. Extremism becomes normalized. The neoliberal and neoconservative consensus is collapsing or has already collapsed. And there's this search for radical answers and the fear that they may find them. You get more social instability. You get this class-based system. So you get classes that have no interaction with the rest of society. So look around Irving, and there's about 10 or 15 walled neighborhoods. There's people who do not even meet anybody else but members of their own class. You get the re-emergence, the re-emphasis of racial differences. Why? Because we need to blame somebody. You get radical division of the classes with lots of class markers. Think about this. You get on an airplane and there's a separate line for those in first class. Why? It makes no sense. They're going to board first anyway. But it's just a marker. It's called a class marker. And it just means we're not going to share this bit of carpet with you peasants. This is a recipe for disaster. Okay. Well, where does that leave us? Oops. Okay. So I believe there are some questions that confront us. First place, think about the moral issues that are involved here. Is this the proper use of money? Is this the proper use of insurance? Are these class divisions, are they in any sense moral? Now, this is our history, but is it just our history? Or is it also our future? And here's what worries me. I see that a large percentage of housing is now being bought up by the corporations. BlackRock, Berkshire Hathaway, lots of big investment firms are entering the housing market big time and turning them into either rentals or Airbnbs. This worries me, quite frankly, because what I see, and I hope I'm wrong, is the same thing happening in a different form. So I think some markets like Houston, 24% of all housing units are owned by are owned by hedge funds. Okay. But here I think is the biggest problem. Do we have the same social capital we had in 2008? Or do people feel that their trust has been, well, betrayed, not rewarded? I think this is an extremely serious problem that you will have to deal with. And you will have to deal with it just as you're getting out of college or getting out of professional school or at the start of your careers. Because I think it's not, the collapse is not more than 2 to 5 years off. That's nothing unusual. In fact, on average, the real estate market collapses every 18 years. Okay? But this is in a whole nother class. 2008 was in a whole nother class, and this is in a whole nother class. So there are indeed serious problems to consider. All right, so let's meet and talk about this, and I look forward to hearing you, to reading what you to hearing what you have to say, and to reading what you have to write on the discussion boards.